Hello everyone, welcome to LuckScout Economic News. Let's dive into the most crucial economic updates from the United States in the last 24 hours. Trust me, these insights will help you manage your wealth more effectively, whether you're an investor or just trying to stay informed. Because let's be honest, understanding this stuff is like flossing regularly. We know we should be doing it, it's just so much easier to ignore it and hope for the best. Alright, let's start with the big one, inflation. It's the topic on everyone's mind, and for good reason. It's the economic equivalent of that weird smell in your fridge. You know something's off, but you're not quite sure what, and you're almost afraid to investigate. You open the door, take a cautious sniff, and hope for the best. Well, good news everyone, the US inflation rate has stabilized at 3.3%. This is a significant improvement from the highs we saw last year. Now, before you start doing victory laps in your living room, remember that's still higher than the Federal Reserve's target of 2%. It's like running a marathon and realizing you still have a mile to go. It's like finding out that the weird smell in your fridge is just a forgotten jar of pickles. Not great, but also not the biohazard you feared. You can breathe a little easier, but you still need to clean it up. This stabilization, however, does offer a glimmer of hope. It's a sign that the measures taken might be working, even if progress is slow. It suggests that maybe, just maybe, the Fed's aggressive interest rate hikes are starting to work. These hikes have been a tough pill to swallow, but they might be the medicine the economy needs. Remember those? Those were fun, weren't they? Like being poked with a stick repeatedly, but instead of a stick, it's your mortgage rate. Every increase felt like a jab, making home ownership more expensive. But what does this mean for your savings and investment decisions? It's a complex puzzle, but there are some pieces we can start to fit together. Well, for starters, it means that keeping your money stuffed under your mattress is still a terrible idea. Inflation will eat away at its value, even if it's not as ravenous as before. With interest rates on savings accounts and bonds finally starting to look somewhat respectable, you can at least pretend your money is growing faster than the rate of inflation. It's not a windfall, but it's better than nothing. But don't get complacent. This inflation beast isn't slain yet. It's more like it's been temporarily subdued. It's more like it's taken a nap. A nap that could end at any moment, especially if energy prices decide to throw a tantrum again. Energy prices are notoriously volatile and can wake the beast. A nap that could end at any moment, especially if energy prices decide to throw a tantrum again. We've seen how quickly they can spike, affecting everything from transportation to heating costs. So stay vigilant, my friends. Stay vigilant. Keep an eye on the economic indicators, and be prepared to adjust your financial strategies as needed. The journey isn't over, but we're making progress. Now let's talk about the trade deficit, which is basically the economic equivalent of that friend who always forgets their wallet when you go out to dinner. Except in this case, that friend is America, and the dinner bill is a whopping $74.6 billion. Yes, you heard that right. The US trade deficit, which measures the gap between imports and exports, has widened again. It's like we just can't resist those shiny foreign goods, whether it's German cars, Japanese electronics, or, dare I say it, British comedy shows. But here's the thing. A widening trade deficit isn't always a bad thing. It can be a sign of a strong economy with consumers and businesses confident enough to spend. However, it can also put downward pressure on the value of the US dollar, making those imported goods even more expensive. And we all know how much Americans love expensive things, right? This trade deficit is also likely to give ammunition to those who argue for protectionist economic policies. You know, the let's build a wall around America but make it out of tariffs crowd. Now, I'm not saying those policies are the answer, but it's a debate that's not going away anytime soon. So buckle up, because things are about to get interesting. Alright, enough doom and gloom, let's talk about something positive for a change. Jobs. The US economy added a healthy 272,000 jobs last month, which is good news for anyone who enjoys things like, eating and having a roof over their heads. This increase in employment is a sign that the economy is still chugging along despite all the challenges it's facing. It suggests that businesses are feeling optimistic about the future and are willing to hire more workers. And when people have jobs, they tend to spend money. And when people spend money, the economy grows. It's a beautiful cycle, like the circle of life, but with less dramatic animal migrations. Of course, not all job sectors are created equal. Some industries are booming while others are still struggling to recover from the pandemic. But overall, the employment picture is looking pretty rosy right now. So go ahead, treat yourself to that extra latte. You deserve it. Now let's talk about something that sounds incredibly boring but is actually quite important. Import and export prices. These prices are the backbone of international trade and have far-reaching implications for the global economy. Think of it like this. When import prices go down, it's like getting a discount on all the cool stuff from other countries. This means consumers and businesses can buy more for less, which can stimulate economic activity. And when export prices go up, it's like selling your old stuff on eBay for more than you paid for it. Higher export prices can lead to increased revenue for businesses, which can then invest more in production and job creation. The latest data shows that import prices fell by 0.4% last month, while export prices dipped by 0.6%. These changes might seem small, but they can have significant impacts on the economy. Now, you might think that falling export prices are a bad thing, but it can actually make U.S. goods more competitive in the global market. Lower prices can attract more international buyers, boosting sales and market share. It's all a delicate dance, really. A delicate, boring dance. But this dance is crucial for maintaining economic stability and growth. These price fluctuations can have a big impact on the trade balance, which we talked about earlier. The trade balance is the difference between a country's exports and imports, and it plays a key role in the overall health of the economy. When import prices fall, it can help to narrow the trade deficit. A smaller trade deficit means the country is spending less on foreign goods and services, which can be beneficial for the domestic economy. But when export prices fall, it can have the opposite effect. Lower export prices can reduce the revenue from international sales, potentially widening the trade deficit. It's a constant tug of war, with the U.S. economy caught in the middle. Balancing import and export prices is a complex task that requires careful monitoring and strategic adjustments. And of course, we can't forget about inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and it affects purchasing power. Falling import prices can help to keep inflation in check, which is always a good thing. Lower inflation means that consumers' money goes further, allowing them to buy more with the same amount of money. But if export prices fall too far, it could lead to deflation, which is a whole other can of worms that we don't have time to get into right now. Deflation can lead to decreased economic activity and increased unemployment, making it a serious concern for policymakers. And finally, let's talk about the big kahuna, the economic indicator to rule them all: GDP growth. This is the metric that economists, policymakers, and even the average Joe keep an eye on to gauge the health of the economy. For those of you who don't speak economist, GDP stands for Gross Domestic Product, and it's basically a measure of how much the U.S. economy is producing. It's like the total score in a game, showing how well the team, in this case the economy, is performing. Think of it like the economy's report card. Just like in school, a higher grade means better performance, and a lower grade means there's room for improvement. The latest figures show that the U.S. economy grew at an annualized rate of 1.3% in the last quarter. This number is crucial because it tells us how much the economy has expanded over a specific period. Now I know what you're thinking. 1.3%? That's it? That's like getting a C on your report card. It might not sound impressive, but let's dig a little deeper. And you'd be right. It's not exactly stellar growth. However, it's important to remember that any positive growth is a sign that the economy is moving in the right direction, even if it's at a slower pace than we'd like. But hey, it's better than nothing, right? Slow and steady growth can sometimes be more sustainable in the long run, avoiding the boom and bust cycles that can lead to economic instability. This revision in GDP growth is important for a couple of reasons. It helps us understand the real state of the economy, beyond just the headline numbers. First, it gives us a clearer picture of how the economy is actually performing. By revising these numbers, we can get a more accurate sense of economic trends and patterns. Second, it helps economists and policymakers make more informed decisions about things like interest rates and government spending. These decisions can have a significant impact on everything from mortgage rates to job creation. So what does this all mean for you? Well, if you're an investor, it means that you might want to temper your expectations for the coming months. The stock market often reacts to GDP growth figures, so slower growth might mean more cautious investment strategies. Well, if you're an investor, it means that you might want to temper your expectations for the coming months. The economy is still growing, but it's not exactly setting the world on fire. This could mean more stable but less spectacular returns on your investments. The economy is still growing, but it's not exactly setting the world on fire. This moderate growth can be seen as a sign of stability, which is not necessarily a bad thing. But if you're just an average person trying to make ends meet, it means that things are probably going to stay pretty much the same. Your day-to-day life might not see dramatic changes, but stability can provide a sense of security, which, depending on your perspective, could be either a good thing or a bad thing. For some, stability means predictability and safety. For others, it might mean a lack of exciting opportunities. Either way, understanding GDP growth helps us navigate our economic reality. Today, we covered the top economic updates that could influence your financial decisions. From the stabilizing inflation rate to the widening trade deficit, from the encouraging employment data to the ever-important GDP growth, we've explored the forces shaping the US economy. Don't forget to like, subscribe, and check out the detailed sources for more in-depth information. Remember, knowledge is power, especially when it comes to your money. Stay informed and manage your wealth wisely. See you in the next video.